Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Levi Strauss Co. quarterly report. Levi Strauss Co. offers a wide range of products and services across various categories. At the core of their business are apparels for men, women, and children, including jeans, casual and dress pants, activewears, tops, shorts, skirts, dresses, jumpsuits, shirts, sweaters, jackets, and footwear. The company also provides related accessories under its four main brands: Levi's, Levi Strauss Signature, Denizen, and Beyond Yoga. In addition to selling products through various channels, such as department stores, specialty retailers, e-commerce sites, and franchisees, the company operates its own retail outlets, including mainline and outlet stores, e-commerce sites, and shop-in-shops. This multi-channel approach allows Levi Strauss Co. to reach a broad customer base and provide convenience to consumers. The company's business model is designed to cater to diverse customer needs, offering both online and offline shopping experiences through its own retail channels and partnerships with third-party retailers. With a rich history dating back to 1853, Levi Strauss Co. has established itself as a leading player in the apparel industry, known for its iconic brands and commitment to quality and innovation. Levi Strauss Co. market capitalization of $8 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Levi Strauss Co. holds a significant advantage in their industry. Levi Strauss Co. trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 3.38 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.84%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline can be identified through a review of recent financial data. On the growth side, e-commerce transactions have been a significant contributor to increased revenues. Direct-to-consumer sales have also seen substantial increases in both the Americas and Europe segments, with notable gains in the Levi's brands and Beyond Yoga lines. In addition, wholesale revenue has decreased at a slower rate than direct-to-consumer sales growth in some segments. The Levi's brands have experienced significant growth across all regions, while Beyond Yoga has also seen an increase in revenues. Overall, net revenues have increased 14.1% year-over-year due to higher revenues across all regions and growth in both DTC and wholesale channels. On the decline side, wholesale revenue has decreased in both the Americas and Europe segments. The Denizen brand operations have resulted in a 100% decline in net revenues following a wind-down of its signature TM Denizen registered line. These factors highlight the importance of e-commerce transactions, direct-to-consumer sales, and regional performance in driving revenue growth or decline. The net income of the company underwent significant fluctuations over the years. Initially, it increased from $135 million to $175.8 million due to higher operating cash flows. However, this trend was short-lived, as the net income decreased by $229.6 million to minus $53.8 million in a later period. The decrease was attributed to the sale of the Dockers business and remaining operations. Despite this setback, the net income increased by $40.8 million, 30% increase, from $135 million to $175.8 million. The profit margins also experienced changes during this period. While the gross profit margin remained relatively stable, the operating income margin decreased from 12.6% to 11.4%. On the other hand, the net income margin increased from 31.5% to 34.3%. However, a closer examination reveals that the decrease in profit margins was due to increased cost of sales and inventory costs resulting from tariffs and trade restrictions. The reasons for these changes are multifaceted. The increase in net income can be attributed to higher operating cash flows. Conversely, the decrease in net income is largely due to the sale of the Dockers business and remaining operations. Furthermore, the decline in profit margins was a result of increased cost of sales and inventory costs resulting from tariffs and trade restrictions. The company's financial performance is a positive indicator of its overall health and stability. One key metric that supports this conclusion is its operating cash flow, which has been consistently generating significant amounts throughout the year. Specifically, in 2026, the net cash provided by operating activities reached $211.5 million for the 3 months ended March. This positive trend continued throughout the year, with an operating cash flow of $76.4 million reported on page 15. The consistency and magnitude of these numbers demonstrate that the company is successfully generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. As a result, it can be confidently stated that the company is indeed generating positive operating cash flow. The performance of various segments and regions was analyzed based on the extracted summaries. The Americas stood out as a strong performer, with segment net revenues reaching $855.7 million and segment operating income totaling $163.2 million. In Europe, the results were also impressive, with segment net revenues of $496 million and segment operating income of $129.2 million. These figures indicate that both regions contributed significantly to the overall revenue and profitability of the company. On the other hand, Asia was a segment that underperformed, with segment net revenues of only $347.5 million and segment operating income of $70.4 million. This suggests that the region faced challenges in terms of revenue growth and profitability compared to its counterparts in the Americas and Europe. Management is emphasizing a strategic focus on the core Levi's brand, while exiting the Dockers brand through sale. This shift in strategy aims to mitigate the impact of tariff actions and trade restrictions. Key priorities include reinvesting in high-growth opportunities, returning cash to stockholders through dividends and share repurchases, and pursuing acquisitions that support current strategies. To drive growth, management has identified several key initiatives. These include elevating and strengthening the brand, growing direct-to-consumer business, improving digital presence, investing in operational excellence, and increasing productivity and efficiency. Financial goals are also outlined, including achieving operating model optimization and cost savings, adapting to changing retail environments and fashion trends, and expanding dedicated stores for products. Management is committed to optimizing operations and driving growth through strategic investments and initiatives that support the core Levi's brand. By focusing on high-growth opportunities and improving operational efficiency, management aims to drive long-term success and increase shareholder value. The company has made significant moves through acquisitions and divestitures. However, it appears that there have been no notable acquisitions mentioned in the provided text. On the other hand, the company has undergone several divestitures. One of the most notable examples is the sale of the Dockers brand, which was completed in multiple closings between July 31, 2025 and February 27, 2026. Additionally, the company reported restructuring costs related to the Dockers brand as discontinued operations, totaling $8.4 million in 2025 and $1.8 million in 2025. These divestitures suggest that the company is focusing on streamlining its operations and reducing its portfolio of brands. The sale of the Dockers brand is a significant move, indicating that the company is looking to concentrate on other areas of its business. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts, with a total payout of $53.8 million mentioned on multiple occasions throughout the report. Additionally, the target dividend payout ratio is set at 25–35% of net income, indicating a commitment to maintaining a stable dividend policy. Furthermore, the company has also engaged in share buybacks, with several transactions noted in the report. These include an accelerated share repurchase of $201 million and another transaction worth $200 million in January 2026. The company's willingness to invest in its own shares suggests confidence in its future prospects and a desire to increase shareholder value. Concerns about inventory buildup and supply chain disruption are evident in the current market. Inventory levels have been increasing, with a notable rise of $140.2 million from March 2025 to March 2026. This trend is particularly pronounced in the Americas, Europe, and Asia, where inventories have reached $681.1 million, $175.9 million, and $186.9 million, respectively. The potential for inventory buildup is further exacerbated by changes in general economic and financial conditions. These shifts can lead to fluctuations in demand, making it challenging to manage inventory levels effectively. Moreover, the uncertainty surrounding global trade, caused by reciprocal tariffs and retaliatory actions, has created an environment of supply chain disruption. Shipping delays, order cancellations, and increased costs due to logistics center transitions have become common issues. The potential for import tariffs or taxes to increase may further impact the ability to plan and respond to changes in the market. These concerns highlight the need for businesses to be proactive in managing their inventory levels and supply chains to mitigate potential disruptions. That concludes the financial summary for Levi Strauss Co. Feel free to comment below, and I will be happy to answer them when possible.